This is Popping the Bubble with hosts Sandra Ponce de Leon and Pete A. Turner.
All right, I'm Greg Gillman, the founder of Science Blockchain, and you're listening to Popping the Bubble.
Hey, Greg, thank you so much for joining us here today on Popping the Bubble. It's really amazing to have you.
My pleasure. Thanks for having me.
Yes, you are such an accomplished serial entrepreneur, and you also have a background in law. Can you talk a little bit about your founding story, about how you came to found Science?
Oh, God. Oh, I'm one of the co-founders of Science, which is a 6.5-year-old incubator and venture fund here in Los Angeles. We're based here in Santa Monica. And actually, it was a really great story how that came together. So I started my first company my second year of law school and sold that one for a little bit of money and went from being completely broke to only mostly broke. Mm-hmm. And then from that point onward, I was like, I can just do this for the rest of my life if people are going to actually pay me for things I just built. And the second company that we started to get off the ground, we hired an outside web design shop and software firm that was run by this guy named Mike Jones, who had this little company called PBJ Digital in the Valley. And Mike and I we really hit it off, and we partnered together on, I don't know, half a dozen businesses between now and then. I was always either counsel or advisor to his businesses, but I was never sort of in the business. And then when he was finishing up at MySpace and thinking, I might do something.
That's right. Yeah, he was from MySpace.
Yeah,
founder
he
of
was
MySpace.
CEO of MySpace.
Okay.
They brought him in as sort of part of the team to maximize the value and sell off the pieces. But he was not a founder of MySpace. But when he was wrapping up there, he had this idea for Science as an advisory / early incubator, and we put together a group of people that were people we'd worked with on a number of projects previously. So Tom Dare, who's our CFO and COO, had worked with Mike at Savo, which was another one of the projects we'd all sort of worked on together a little bit, backed by a private equity firm that they had gone on to sell. And then Peter Pham, we'd never worked with directly, but we'd known for the better part of a decade at that point, because I swear everybody knows Peter, because that's essentially his job. He is the great connector, and he is the one that raises all of the funds for our follow-on funds for our portfolio.
Oh, okay. Great. And does Science have a particular investment thesis?
In our earliest incubator, we were getting involved in sort of three primary areas. There were sort of marketplaces, mobile, and e-commerce. Mm-hmm. And generally, we look for places where we can make data-driven decisions and help teams understand what's driving their business in areas where we have expertise. So we're actually adding some value. Mm-hmm. That generally meant we steered clear of things like enterprise software and things that we didn't really have too much expertise on in the building. And the reason we sort of founded Science and how it evolved over time was we saw a bunch of similar or common areas where startups would sort of fail, mm-hmm. Where they would run into the same problems, and what we wanted to do is try to reduce those to the greatest extent possible. So we built a sort of internal engine for a lot of these companies where they could tap into resources that we had at the Science level. So great design, development, customer acquisition, where we could afford as an incubator to have these groups of people and these sort of, best of breed types, sitting in our office that most startups couldn't afford on their own. So allowing them to leverage off that internal system gave them sort of an advantage and a leg up. And it helped, it really worked well for companies like Dollar Shave Club, where they could come in and we helped them rebrand and help them sort of launch their original platform, and then they stayed with us for 15 months or so, and then until I think they'd grown to 25 or 30 employees, and I think they were pretty much crammed into 300 square feet or whatever we could spare in the office at that point. And we're like, hey, it might be time to move out. But mm-hmm. they were able to tap into those resources so they could spend their capital more efficiently to grow further on what they had raised.
Yeah, that makes a lot of sense. I don't understand why more VCs wouldn't do that, because it's obviously in your vested interest to make sure your startups are succeeding.
It is. It's also a lot more work.
That's true.
We get really operational with the company. So mm-hmm. we come in as a co-founder, sit high in the cap table, and they essentially get, the entire Science organization as their second, third, fourth co-founder, and then sort of get to leverage all the resources we bring to bear. But that means we are helping operate a large number of businesses, which is, significantly more taxing than writing checks.
Yeah. Wow. Huh. Very, very cool. What do you think are some of the most common errors that entrepreneurs make as they're embarking on their journeys?
I think, at the earliest stages, a lot of entrepreneurs are fascinated with the idea of secrecy, right? They're all like, oh, I don't want to tell you my idea because you might steal it. Well,
Right.
the reality is there are very few sort of totally original ideas, and we hear a lot of the same concepts over and over. And what they really should be doing is talking to as many people as they can about what they're doing, because that lets them tap into their network or our network or whoever is trying to help them out and actually help them build the business. I think, and I see it all the time, and I was guilty of it when I was starting my first companies as well. It's like I'm afraid somebody's going to steal the idea. It's a lot more about execution than it is about the original idea.
Huh. Yeah, that's great advice. Well, we actually are here at the Start Engine Summit, ICO Summit here in Los Angeles, and you just spoke on a panel about ICOs, which are initial coin offerings, and how they're potentially disrupting VCs. How do you see that market impacting the traditional venture capital market?
I think it has hit over the last year the early and seed stage venture market fairly directly. We are generally investing at that earliest seed stage, and in 2017, a lot of that activity was shifted into ICOs because they were liquid. So instead of writing a $250,000 check into a convertible note of a company where we might see liquidity in 5 or 10 years, we could redeploy some of those funds into the ICOs of these companies and be liquid in 3 or 5 weeks, if not faster. That a lot of that opportunity has sort of started to diminish as companies are moving their ICOs earlier in their process and they don't have a system ready or tokens ready, so that you're not as liquid as quickly. And it's also getting significantly more expensive to run an ICO than it was in early to mid 2017, simply because there are so many more of them.
Right. So what would be the cost for running one?
I think you're going to have a great variance depending on how much you're trying to raise and the legal complexity and your marketing budget. But I think unless you're allocating at least, probably $500,000 to $1 million to your ICO process, you're probably not allocating nearly enough money. And I think probably more towards the $1 million end of that spectrum. Once you factor in, legal and tax and everything, depending on the particular offering, and then your marketing budget is just sort of on top of all of those foundational items like your legal, tax, and accounting.
Right. And there's been some phenomenal sums raised in the ICO world.
Oh, absolutely.
Oh, I mean, what do you, I mean, obviously there's benefits to that for the founders and they get to put that money to use right away, but is there any cons that you see in terms of just giving an entrepreneur that much money straight out of the gate?
So ICOs don't come with governance and they don't come with boards and they don't come with oversight and people don't generally know what they're buying. I think there are a lot of cons to allowing companies that have no product and have no traction and have no history at all to have $100 million, $200, $500 million, right? Like, there's a reason that venture doesn't generally deploy money like that. It's because it can't be spent efficiently.
Right.
So, some of those large raises are now, and, I can't say I fault them for this. And in fact, it's in some ways, financial planning genius. They're now seeding venture funds that will fund companies that will build on their platforms, right? Because they've raised so much more money than they can realistically spend on their core business.
What's an example of that?
Almost all of the large raises have these now.
Really?
So, yes.
Really? Wow. Okay.
So EOS and NEO
That's right,
and NEM
yes.
and Tezos all have
like,
funds.
what do we do with all this money?
But I mean, it's a very smart use of capital, right? Like, instead of hoping that people come to your system, you, just like you're doing with your core token, you're incentivizing the behavior that you want. So we'll pay you to build on our system, right? There are only so many talented developers to go around. There are only so many projects that can succeed. So you might as well, especially since if you're built on your protocol, it is likely to benefit the underlying protocol token holders.
Right.
You want the best and the brightest building on your platform, you might as well pay them to do it.
Well, yeah, what are some of the ICOs that you're seeing coming up that you're particularly excited about, whether you're investing or not?
So, I will say that we have one that's in the market now, which is a company called Springroll. Well, Springroll has agreed to accept the token of the Spring Foundation, which is Springroll itself is think of it as an incentivized LinkedIn, right, where there's an incentive to tell the truth and to verify true credentials and attest to the actual abilities and education of the people you know. Because what it's really hard to do? It's really hard to look at 50 resumes on LinkedIn or profiles on LinkedIn and figure out which one of them was actually part of the founding team of Snapchat, right? But there are probably 500 developers out there that say they were part of the founding tech team of Snapchat, right? So what Springroll is doing is creating an incentive and using the token to incentivize user behavior so that I can find out, you can verify, for example, that I graduated from USC Law in 2000, right? Like verified fact attested to by others so that when, companies are looking to hire, they don't have to start from scratch to figure out whether any of the stuff that people are telling them is true. I think it's a great use of a token because of the limitations placed on me by the fact that we own a security token. I'm not going to say anything else about any other offerings just because it puts me in a weird spot from a legal perspective.
And you definitely know the law.
Well, I have other people that know the law far better than I do, but and they'd be telling me to shut my mouth now.
Oh, okay. All right. So we won't go there. We just talked about that. Well, I guess I'd be curious to know, your journey as a lawyer into entrepreneur. And, obviously now in this market, lawyers are everywhere.
Right.
You have to have a lawyer. So it must be a big benefit, in terms of what you bring to the company.
It's actually really weird in that in some respects, it's kind of like the convergence of everything I've ever done in my life. So, I mentioned that I started my first companies in law school. I actually wrote my law review note on BOE bonds and the securitization or asset-backed securities with these sort of unusual securities, which at the time were kind of interesting and novel, but there wasn't much of a market for them because there were very few purchasers of these, $15-20 million offerings that were then not really liquid. And anyway, you fast forward to 15 years later, 17 years later, and there's this new mechanism for actually making these asset-backed securities potentially liquid. So yeah, it's one of the few times probably in life where it's beneficial to have a background in law and to actually be the lawyer on the team, because it is an area of law that is emerging and changing so quickly. With the .com 1.0, there were not really a lot of new and novel legal issues. There were a lot of new and novel sort of business arrangements and commercial agreements, but it was basically companies raise money, they go into business, they do whatever they do, and they exit, they sell, they go public. Like, not a lot of controversy or new issues. Here you have like radical new potential changes or emerging issues in securities law and international law. I mean, like there's a large scope to the issues here that are being determined sort of in real time now. So yes, it's definitely beneficial to have that legal background. After law school, I for a year or so toiled on the company that was dying on the vine in the first .com crash, and then ended up being recruited by a bunch of my former vendors/friends that said, hey, you're a lawyer and you know the business side of all of this, because this was still pretty much the wild, wild west days of .com 1.0. Can you come help us with this? Can you come help us with that? And a lot of that was technology and entertainment related issues, which was sort of what I was interested in and had studied most in school, was intellectual property and corporate law. So somehow I ended up representing some random famous recording artists on like domain name issues and things like that, like weird stuff that, because nobody really knew what they were doing so much back then. Otherwise I wouldn't have, called up a first year lawyer and said, hey, can you help me out with this stuff? But I sort of found my way through that and practiced law for a couple of years, and then got recruited to go run the Center for Entrepreneurship and Technology Law at Pepperdine Law School. While I was there, I got to design and teach courses in intellectual property and licensing, and it was sort of a random fun interlude in life where I started when I was 29, not that much older than most of the students, and really, really liked the teaching, and also knew immediately that academia was not for me. It moved way too slowly, and there are no politics quite so petty as those in academia. But I was sort of lured out of there by my brother, of all people, to go start this healthcare IT company, because he had this crazy idea that turned out to be totally correct. It's taken a long time to get there, but
what's the name of that company?
A company called RxVantage, and it connects physicians and other healthcare providers with pharma and other players in the industry for educational interactions, and it helps coordinate the pharma sales forces, and there's all sorts of benefits to it. And it's now finally making real revenue and has large pharma companies as customers, and has for years, but it's been a long slog to get there. And we're fortunate to have very patient investors there. So I think a lot of if I put my investor hat on, I owe a lot of my patience as an investor to the investors we had in that company, because they were sort of great role models. That company's is profitable and on a path finally. But when Mike came calling and said, hey, I really want to put the science thing together, I said, well, it actually times out well because I can provide a lot of the same benefits to RX managers that I was currently, and then not have to be on payroll, which gave them an extended runway, which is what ultimately allowed them to make it over the hump and get to profitability. So it actually really worked out well.
Wow. Yeah, I think that's probably a problem, especially in this market now with investors, just that lack of patience, right? Everybody wants to, I mean, there's been so much money made in ICOs and crypto that, people just are investing maybe for the wrong reasons.
Without a doubt, it changes your sort of time horizon. In some ways, and I think I heard David Seymour say this morning, he was like, just pretty much forget everything you ever learned as a venture capitalist if you're going to then go and invest in crypto. Fortunately, I haven't, even though we have a venture fund, I've never considered myself or thought of we certainly don't think of ourselves as venture capitalists. We're sort of more company builders that have capital to deploy as well. You still sort of analyze companies the same way, right? Who are the great teams? What are the projects that they're chasing? And which of those projects, if successful, is going to be really big? And that's where we want to spend our time, which in theory should be the same way you would think about token offerings, because ultimately what you're buying are, essentially future credits or future usage of these platforms, and you're betting that the platforms are going to become so successful and the supply of the tokens is going to be so limited that the tokens will appreciate in value. That's really what people are buying when they participate in most of these ICOs.
And the fact that they have access to liquidity so quickly.
Right.
Yeah.
I mean, that just makes it much easier in some ways than investing in venture, right? Because if you don't like it, you can get out. So the risk of it going to zero is less likely than in venture where you can't get out. So where the downside is the same, you both go to zero, but you can hedge that with a token holding. And at least in 2017, you had the chance of near-term material appreciation very quickly. Right.
So what is some advice that you would give to an entrepreneur that is in the process of launching an ICO, besides having proper budget, enough budget to cover the costs?
Counsel, like there are a number of firms that are out there now saying, oh yeah, we do this stuff. There aren't that many people that have actually done this for more than 6 months. Find yourself good counsel that understands the technology, not just the security side of it. Make sure you're building a real product. Probably think about an ICO after you've raised some other capital and you've actually made, put together a team and started to make traction, and then hopefully are on the verge of pushing product. We generally, for our portfolio company, will not even think about getting into an ICO process if they're more than 90 days away from launching their system, because it just doesn't make sense to us, right? Like, if you're more than that, then you should just keep building, and we'll figure out a way to get you funded if you need it. Otherwise,
Right. Yeah, I've seen that as a trend as well. There's, the funding before the ICO to cover the costs and the development.
Right, and it's, as I said, it's an expensive process,
Yeah.
And to do it right means generally doing it globally, and that's, a global roadshow to crypto investors is not something that most young companies can.
Hey everyone, this is Sandra from Popping the Bubble, and we're coming to you from The Vault in San Francisco.
What's the Vault?
Well, thank you for asking, Pete. The Vault is a full-stack innovation ecosystem and collaborative workspace.
Full stack innovation, ecosystem, collaborative work. That sounds super techy.
Well, you're right there, Pete. Full stack means that in addition to being a great place to collaborate and network for startups, The Vault has a full suite of startup advisory services, such as fundraising help, legal, IP, and marketing services.
Let's also mention how the Vault works with corporations through Viz, the Vault Innovation Services, and VIA, which is the Vault Innovation Academy, which also offers courses in developing innovation at scale.
The Vault celebrates innovators from around the world and provides entrepreneurs with the right tools and support to grow better and faster.
This segment of Popping the Bubble is brought to you by The Vault. Thanks to Kevin and his team for all the amazing work they do to fuel innovation in Silicon Valley and across the globe.
Afford on its own, let alone all the legal and tax costs that come with it.
Right. Do you see more trends towards not actually having ICOs in the United States, given the legal requirements and the SEC requirements?
Yeah, absolutely, which is really kind of disappointing.
Yeah.
Right? I think there's been a certain amount of uncertainty and fear in the market, largely based on, some of the large law firms that were most aggressive in the early days suddenly reversing their position because they realized they'd gotten out over their skis a little bit, I think, which is, not an unreasonable position for them to take. But, that combined with a few sort of informal comments from, Chairman Clayton led to a sort of immediate drawback of the market, and a lot of companies then deciding it just wasn't worth the risk to offer in the U.S. I think the SEC, by and large, has been, gentle, deliberate, and appropriate. I wish, that we had had regulation 3 years ago, because we'd be 3 years further along and know exactly what we can and can't do with this sort of emerging offering. I mean, that said, everybody says they're waiting for regulation. These things are already regulated. They're waiting for changes in regulation, right? Like, because they don't like the answer that they're going to get
right.
with a lot of these offerings.
We're talking about utility tokens in particular.
Sure, exactly. There is no such thing as a utility token under the securities law or any other law that I'm aware of, other than maybe in Wyoming. There exist frameworks of regulation for all of these things, and it is, in my view, 100% possible to have a compliant utility token offering in the United States. And it's not even, it's not rocket science, but because, some of those firms that were the biggest cheerleaders of this under one or two particular approaches that may have been a little bit more aggressive than, looks appropriate in hindsight, pulled back. You've seen it pulled back of the entire market. And that's just going to lead to jurisdiction shopping. So I have a feeling that, we'll have some more guidance, I hope, this year. It might be overly optimistic, but I have enough confidence in, the non-elected officials in Washington to think that they are aware that the U.S. risks becoming sort of a jurisdiction of second, third, or last choice if we don't have a coherent and reasonable policy on this. And it's almost unfathomable to think that, if there's a parallel to Internet 1.0, if all of those companies like the Facebooks and Amazons and others of the world were built in Estonia or Japan or Malta because they had more favorable regulation, what would that have meant to the U.S. economy? Right? And that's pretty much what we're staring down the barrel of right now. So, I'm hopeful that people continue to figure out ways to have these offerings in the U.S. and that there is some comprehensive, coherent, and productive legislation coming.
Yeah, absolutely. Let's hope for that, because we also want innovation to continue to happen here in the United States.
Absolutely.
Yeah. Well, it has been a great conversation, Greg. Thank you so much for joining us today. Is there anything that you'd like to end on, or how can people get a hold of you or find out more about science? Sure. So they can find us at science-inc.com, and all of our contact information and everything else is up there, and that's probably the best way to get in touch with us. Awesome. Thank you. All right. Thank you.